All right, how y'all doing today, bro? All right, so today I'm gonna be going over some smart money terminology. So, for example, I'm gonna be showing you guys like what order blocks are, fair value gaps, buy side, sell side, previous daily high, previous daily low. Just talk about in detail a little bit of what these things mean, so you guys could kind of understand them, and you'll be able to understand. Understanding these are key because if you go and you say you want to learn a strategy, they don't understand how to implement these things and what they really genuinely mean. Okay, so first thing we're gonna start off with is a fair value gap. All right, so a fair value gap. Here's one right here. A fair value gap is a gap in price that's delineated by a three candle pattern. All right, so all right, so this would be considered a fair value gap right here. So you see how you have a candle here, you have this candle, and then this candle's wick. So these two wicks make up the gap. And this space right here between both candles are considered a gap. Now, this is also known as the inefficiency in the market, meaning price wasn't fulfilled to the other side of the market here. It wasn't offered to sellers. As you see, this is strictly buy momentum. So sellers didn't have a chance to balance the market out. So this is efficient price action here. As you see, price going up and down, because market moves in waves. So just like here, they only offered buying. They had to come back, fill it, and offer selling. Now, this is important, and these fair value gaps are very good to be used in trading, and people trade them because of the fact of price having to return to that area to balance price out. So if price doesn't come back to this area, that's going to be inefficient price action, and price action has to be efficient for the market to move, for the market to function, if that makes sense. So see here, price is offered on both sides. Price is offered on both sides. And see here's the gap. This is only offered for sale. So what happens? Price is drawn back to this area to balance it out, which it does, continues down. All right, so that's a fair value gap. I'll give you guys another example if I can find one. There's one right here. Same thing here. Price is forcefully pushed down here. A lot of bearish momentum. The fair value gap will be delineated by this area here. Let me mark it up for you guys. So this whole area here is considered fair value gap. Here, price comes in, fills it, taps, bounces off, takes out sell side liquidity. All right. So that there is a fair value gap. When we talk about fair value gaps, that's what people are talking about. All right. Next thing we have is our order block. So order block is the last down candle before up move, last up candle before down move, right? That's the simple version of it. Fair value, an order block is delineated by a sweep of liquidity and is considered a supply or demand zone based on which side of the market you're going towards, right? So people think, order block is just one candle. It's not just one candle. It's every candle in succession before the up move. So see here, you have this up move, right? Which is a gap. You have this gap. See this candle here, you have this candle here. This is the actual order block. Now here you have an order block here inside of it, but this is the order block that the price is gonna go off of. Why? Because this down move happened before this up move. So this candle and this candle are considered an order block, like that. So that's your order block. All right, same thing here. This whole thing is considered an order block. Now, I use this in a trade, so I'm gonna give you guys a little more context. I'm gonna give you guys a tad more context, right? I use this in a trade. This part got mitigated, so then I went to use this one because we mitigated price here. So price here came down, tapped in, and then I follow my strategy, boom, boom, all right? Let me find some more order blocks for you guys. Here's an order block here. This will be considered an order block, and this is just one candle. So this one candle here is an order block. All right. This whole thing right here would be considered an order block. These two candles before this up move here is considered an order block. All right. The order blocks happen pretty much every single day because they're a very important part of price. Now, I found valid order blocks. This is when you start building concepts on concepts. To find a very valid order block, the stronger order blocks are the order blocks that have inefficiency or fair value gaps above them. So, for example, this is a very strong order block. So, subsequent down candles before the up move. And what do we have here? We have an inefficiency validating this down move before the up move to show momentum. So this is a very strong order block right here. Same thing here. This would be a bearish order block. Now, this didn't play out because of market session changeover to London session, and there's a whole bunch of other stuff at play here. But I'm just giving you guys an example of a nice order block that you would want to trade. This is a nice order block. Inefficiency here. All right. Let me see. It's another good one. Here we are here. Price took this out, used this as inducement, and it continued down. But then ultimately it was a reversal and price took up. But see here, price tapped back into it. Inefficiencies in tandem with the order block. So that's how you know you have a strong order block, if it's inefficiencies in tandem with the order block. So that's basically what an order block is, and that's basically what a fair value gap is. Okay. Now, buy side and sell side liquidity. What are buy side and sell side liquidity? Buy side liquidity is the liquidity that rests above certain highs, and sell side liquidity is liquidity that rests below certain lows, right? So any major low that you see or key low will be considered sell side, and any major high that you see will be considered buy side. So this trade that I took here today, I was targeting buy side liquidity. Why is it buy side? Because I'm buying and I'm taking out the liquidity that rests above this high. That's my target. I target the liquidity pool above this high, which we did here. So this would be considered a buy side scenario. Now here, you're selling and you're trying to take out a low. Price comes down, takes out this low. Sell side liquidity. Right? Now you have two different types of liquidity. You have internal range liquidity and external range liquidity. Internal range liquidity is your low-hanging fruit or your easy to attain liquidity. External range liquidity, you have to be a little bit more experienced to be able to trade. All right. External range liquidity would be considered this and this right here. Now see, there's a lot that went on at play here, which is why I knew this would be taken out. But this is external. This is internal. So these are your easy to trade scenarios. So see how I got in here? This is an easy to attain high. This is easy buy. Relative equal highs here, buy side liquidity. So when you're mapping out liquidity, and I'm gonna make a video about liquidity, so I'm not gonna go too much into liquidity here. I'm just trying to give you guys a little context of what it is. Liquidity rests between above every high and below every low, above relative equal highs, below relative equal lows, below equal lows, all of those things. So these are relative equal highs here. So this is a good example. Relative equal highs. And this is interior range liquidity because it's within this range, the external here and external here. So this is all interior liquidity. All right. So what we talking about? Buy side, sell side, fair value gaps, order blocks. Also, if you guys have any questions, you just leave them below in the comments. I'm just trying to touch on what these all are. I'm not really going deeply into detail about them or how to use them, because that's when you start talking strategy. This isn't really strategy. This is just like definition type of video, okay? All right. Let's see, what else do we have? Fair value gap, order block. You have breaker blocks. I don't really use breaker blocks, so I'm not really gonna touch on breaker blocks here. I'm not gonna say I don't think you need them. I could say I don't think you need them because they're not like the most valuable thing. A lot of people just trade strictly order block and fair value gaps. So, but if you do want to learn about breakers, I would suggest to look them up and see how they can play in tandem with how you trade, right? PD array. So a PD array is basically the things I was naming out: order block, fair value gap, breaker block. You have a propulsion block. What's another word? A rejection block. So all of these type of things are considered PD arrays. Now you could look up online a PD array matrix. Actually, I could do that. I'll do that for you guys. Why she's smiling just like that? I'll just play. All right, let me see. Bring up a picture for me. All right, here you go. So this is the PD array matrix. No, go back. Oh my God, wrong way. Okay. So this is the PD array matrix in terms from high to low. So then you have your premium. Oh, you have your premium and your discount. I'm gonna show you guys how I find my premium and discount, but you have a premium discount based on a range. This range that your premium discount is located within and based on is your dealing range. I find my ranges a little differently than other people find their ranges, but I'm gonna give you guys how I find my range so you guys could see a way in which you do it. But yeah, so you have these different areas, and these are all PD arrays. Now, knowing each PD array and drawing each PD array on your chart is a little excessive, which is why people do. Some people learn all of them and go like that, or some people just stick with two. The two that I recommend that you stick with, if you do stick with them, are the fair value gaps and the order blocks. The fair value gaps and order blocks are very, very good, and you pretty much don't really miss any trade once you really understand how to use fair value gaps and order blocks, okay? Those kind of take care of the bulk of trading right there. This is the PD array matrix, all right? All right, now we're gonna talk about this Forex factor. We're gonna talk about how I find my discounting premium. All right, so I already have price marked out here. All right, so I have my midnight open and New York open. What are those, you're asking? A midnight open is basically the opening price at midnight. So the opening price for a selling candle is, the high, not the high, but the higher part of the body of the candle. So let me get closer. All right, so see, this is the high of the body of the candle, the higher part, not the wick. The wick is considered the high, but the high of the body is considered in the sell, with the sell candle, the open. If this was a buy candle, for example, like here, this would be the open, okay? So you have your open. Your open is just basically a key point in price in which price is gonna use in this paradigm of where it's gonna take out liquidity, if that makes sense. All right, so you have your midnight open, then you have your New York open, and then you know your New York open be here. I'll still sell candle, so I can show you guys. But yeah, same thing as this one, right? The high, the body of the candle. Cool. So the way I personally find my premium and discount or market equilibrium is based on where we are with the opens. So if we're below both opens, which is why you see I bought here, if we're below both, we're looking for buys. This is a discount. And you'll only know where you are after 8:30. So all of this over here is just a part of price action. This is just areas and PDA rates to go off of. That's all we use London for if you trade New York. And trade PM sessions as well. So here we are with the discount, vice versa. Our premium is when you're above both opens. So here we'd be looking for sells. So you could be looking for sells since we're above both opens here, and we've taken out buy side liquidity. Perfect scenario in which we want to sell. All right. Now let me go to another pair for you guys, actually. All right. Now when we're in here, I consider that a consolidation range where we're just in between here. I consider it consolidation because we're not in an extreme of discount or an extreme of premium. So in this area, I wouldn't sell. I wouldn't trade. I mean, this one marked out. Yep. There we go. So we're below both here. Had some buys. It wasn't like a crazy buy, but it was buys. Let's go US 30. US 30, same thing. Here we are. 830 opens here, all the way over here. We were below both. Had some buys in here. We're above both. Had some, took out buy side. We took sell side out here. Internal sell side, internal liquidity. We took out sell side here, buys. Took out external liquidity here. Took out buy side, sell. All right. So you see how you could kind of use the opens to piggyback and get trades. That's another video for another day, but I'm just giving you guys a little context, all right? So yeah, I think we touched on pretty much everything. Buy side liquidity, sell side liquidity, internal range liquidity, external range liquidity, order blocks, fair value gaps. That's pretty much it. Now for these trades, I used inverse fair value gaps. I'll go ahead and give you all context on that as well, because we don't gatekeep around, you know what I'm saying? So what is an inverse fair value gap? This is something I'm fairly new with, and I've fairly newly been trading this. I didn't take these trades, by the way. These are demo. These are for show. These are for demo. These are demo. I demoed these. I didn't take these. The trade I actually took today, and I have proof that I took today, is this one. I took this one for a fact. But no, US 30, I was back testing before this. And I mapped out just so I have some examples to show you guys. All right, so here we go. So an inverse fair value gap is a fair value gap that gets violated. All right, and signals that a reversal is happening. So for example, here, see we have a fair value gap. We have a bearish fair value gap here. One candle, the body, two candle, fair value gap. What you look for with proper fair value gaps is for price to tap into the fair value gap and then reject. That's what you want to see. In this scenario, price violated it, and you had a body close. Anytime you have a body close above the inverse of that fair value gap, you have what you know as an inverse fair value gap. So here's two examples for you guys. So see here we're looking for sales. We're not looking for sales, but I'm just giving you guys a kind of example. We have a sell side with a sell right here. We took sell side out. And these occur, and you want to trade these after you've taken out buy side or sell side based on the market paradigm of what I gave you the opens, right? Took out sell side here. That's what this line is delineating. Here we go. Fair value gap got violated here. This had a body close above that candle. All right. Body close above that candle. From that point, you could sell. I mean, you could buy, but you see he had it retest, came down. And you would take it to buy side, sell side liquidity based on whichever one you're trying to do. So boom, happened there. Same thing here. Make it so you guys can see better. All right, here we go. So here, same thing. Candle, candle. So in this case, this is a little weird. This is a little weird when it comes to fair value gap. This whole thing would be considered a fair value gap. Or that's find this on a 15-minute. Nah, that's 5 minutes. Okay. This whole thing right here would be considered fair value gap. You'll come to understand a little bit better once you guys really study fair value gaps, but this is a fair value gap, technically. All right. So it's a technical fair value gap. All right, what happened? Inverse, boom, boom, retest. I use 5-minute engulfments for my personal strategy. I'll drop a video on my personal strategy soon. Comes down, closes. I enter on its close. I would have entered on close. I was back testing this. Boom, boom, boom. And I just took out this right here and took price, or it took price to the open. So you could use these opens to take price to. That's what I actually did for both these examples. Now I'm looking back at it. I took price to the midnight open instead of buy side. When I saw buy side get taken out, I took this to the New York open. So these opens are very useful in terms of what you do. All right, so that's an inverse fair value gap right there. All right, I think I touched on everything. If you guys have any questions about any other concepts, or you want to get to know any other PD array a little bit better, I think I've touched on other ones that I properly use and that I use well. Because you don't need all the PD arrays. You don't need every single market structure model in order to be successful in terms of trading, right? So that's another reason I don't talk about breakers and mitigation blocks and rejection, because I don't use all of that. Personally, I don't. You want to keep trading as simple as you can. So I only use about 2 different ways to trade. Inverse fair value gaps have been added in tandem with order blocks. I usually just trade order blocks. But I hope this was a good example for you guys. I hope this helps you guys out. I hope this helps you guys understand a little bit better of the terminology of trading. And if you have any more questions, leave them below in the comments. I got you guys, all right? Have a good one.